Hi, I'm Marko Kurek,
I'm Vincent Casey.
and we're going to be going over the new accounting rules regarding.
All right, so a brief summary. Rules of leases on financial statements have changed for international companies. It used to be that leases could be reported in the footnotes section of the financial statements. Now they're going to be reported on the balance sheet as assets and liabilities. Problems arise because now that leases are going to affect sales and liabilities, some ratios will appear skewed compared to what they may have been in previous years. Managers are implementing new performance measures to make the financial statements appear more fluid than they would if they had been left completely alone.
So is it a capitalized lease or is this leases for property or everything?
It's all leases, so that's why we're going to go into it more in
Okay.
future slides. For like, there's this
Okay.
company based in Paris, Orange, and they
hmm
have a lot of property and equipment leases, which would really
Okay.
affect their earnings. So they have some precautionary measures that they're going to implement to make sure that it doesn't skew the financial statements.
Okay. So
Yeah,
to make sure I understand it, they're going to this liabilities to both go up.
Yes, but it's
yeah.
going to change current assets and whatnot. Like, it's some are going to be put as current assets, current
Oh,
liabilities, and depending on the lease.
okay.
Key issues from the financial statement analysis perspective. Statement analysis perspective is that certain aspects of the financial statements may appear to be weaker or stronger due to the addition of leases on the balance sheet. One of the largest concerns is the spike in free cash flows. If investors see that a company has more cash left over after expenses, the company's reports will appear much more attractive than they actually are. Leverage ratios are a component that investors use to analyze the risk associated with a company and their ability to pay off debt. Weaker leverage ratios could turn away investors because the company may appear to have more trouble paying off their debts than they actually do. Earnings per share is another gauge that investors use to determine a company's profitability. Weaker earnings per share could make investors feel the company is becoming less profitable. So aspects that may appear higher due to the new reporting standards are earnings before interest, taxes, depreciation, and amortization, and higher free cash flows. The leverage ratios and earnings per share measures are going to appear weak.
Okay, so what step does this affect? So the step in the financial statement analysis process that this affects is the investor's ability to make future predictions based on past financial data. So let's put ourselves, say, 5 years in the future, and this change was implemented 2 or 3 years in. So if a company has had 3 years of increased earnings per share and increased profitability, then this change makes it appear as though for the past 2 years their earnings per share and profitability have been in a slump. Investors could be less likely to purchase shares or other securities the company is offering for trading. And on the flip side, if it were free cash flows, it would appear that the company has had not that much cash after expenses, but now in later years, they've had a lot of cash after their expenses, which can make the company appear more attractive.
Now, will firms have to go back and restate prior years so there is comparison?
Well, no, I'm going to get into it on the next slide on how they're going to affect earnings. What the company
Okay.
they're going to add a new kind of a new thing to the financial statements.
Yeah.
So to the company is so we'll get into what the companies are doing for it. So companies will not have to take measures to assure that changes in reporting standards do not skew company performance appearance to investors. These changes will also make it more difficult for current shareholders to compare past results to current performance and judge the success of the company. So a Paris-based company, Orange, will replace earnings before interest, tax, depreciation, and amortization with earnings before interest, tax, depreciation, amortization, and leases to reflect the company's large number of leases and how payments associated with them affect earnings. So what companies are going to do is they're going to add these new accounts to the financial statements, which are going to include leases to kind of balance out the addition of leases in the accounts. I don't know if I'm really explaining that great, but what it's supposed to do is it's going to bump down earnings, and it's going to make all the ratios kind of more even with previous years, because they can't really adjust. They're not going to go back and adjust like 10, 15 years or like even 3 or 4 years of previous leases and add them into the balance sheets. It's going to be future years after the change is implemented. They're going to try and add these accounts to make all the ratios kind of more fluid with the.
Okay, let me test my understanding. So right now, these leases are operating leases where they just make payments and the payments go through rent expense.
Yes.
Yeah.
Okay, so what they're going to do, if I'm testing my understanding, is there's going to be an asset called leased whatever, and there's going to be a liability, and you have to recognize the depreciation and the interest expense as depreciation and amortization as opposed to rent.
Yeah, so what it is, it's going to be leases payable is going to become, I think I read on the bottom of the article, an account, something like if there were no management precautions taken, it would be, say, leases payable as a liability, and then it would just be like lease as an asset, and say it's like a piece of equipment. So it would be equipment lease would be your asset. So you have the asset is the equipment lease, and then the liability would be the lease payable, because a lot of these companies have long-term leases.
All right, so the balance sheet is what's really is going to really be grossed up. In other words, the balance sheet assets and liabilities will go up.
Yeah, the balance sheet's definitely the main report that's going to be affected.
So that way, when we look at leverage and the relationship between debt to equity, this is going to cause a firm to be more leveraged.
Yeah, it's going to make their leverage ratios weaker. So it's going to make it look as though they're having more trouble paying off their debts. Like they're going to have on the financial statements more debts than assets in previous years. So it's going to look as though they're having trouble paying back their debts. Like their current assets and current liabilities, it's going to go into those accounts.
Okay, so we're going to see something. The balance sheet is what's really going to be.
Yeah,
and it could be. Yeah, go ahead.
It's mainly the balance sheet. Yeah.
Okay, and then you're going to have reclassifications on the income statement. But wait a minute. Now that I think about this, if you depreciate it, wouldn't that generate free cash flow?
Yeah, the free cash flow is becoming. That's why free cash flow is becoming bumped up.
It's going to inflate free cash flow.
Okay.
It could make it look like free cash flow is higher than it.
Yeah, the companies are going to have more free cash after expenses with the increases in depreciation and whatnot.
By the way we calculate it, yeah.
Yeah, when it's calculated.
Air France is going to switch to a metric called adjusted operating free cash flow to include the company's lease payments and to prevent inflating the free cash flow.
Ah, okay. Because they lease a lot of their airplanes, I suspect.
Mm-hmm.
Yes.
Interesting. Interesting. Okay. So now let me just, as long as we're talking, now one of the things we're going to talk about next week, and I don't know if you looked at the stuff for next week, probably you're a little bit busy, both of you guys, but we're looking at what we call normalization, where we try to make things look comparative. So I guess then if we were trying to analyze the company, we would have to go back and estimate that. So if we were looking at trends, we'd sanitize the numbers for that.
Exactly. That's kind of what this whole article is about. It's trying to make it, I guess, trying to make this new implementation not affect the long-term trends, because after like say 2 years after this gets implemented, if their EPS, their profitability, their liquidity ratios all appear either weaker, stronger, whatever it may be, it might look like the company's in a slump or they're performing much better than it would be. So it's up to kind of the accountants from their perspective to make it easier for the investors to get like an actual good gauge of where the company's at.
Because we may be looking at it from two perspectives. One is that we need to know that there's really a liability, so that's a fair representation. But from an analytical perspective, we like to see consistent trends, consistently prepared trends.
Yes.
Okay. Good. Okay.
Okay, and how will this affect us? So, as most of us in the class are accounting majors, some of us are finance majors, finance minors, it's important for us to understand the rules of international reporting in case we find ourselves working for one of these companies or potentially investing in one of these companies. From the accounting perspective, we need to be able to present the financial statements in a manner that will provide fluid analysis experience for potential investors and make it as easy as possible for them to compare statements. From the finance perspective, if we were to invest in one of these companies, if the company does not take every measure and precaution to ensure that the statements are adjusted for with this new rule, it's up to us not to get skewed by figures such as liquidity ratios and EPS and look and analyze further into the financial statements to get a gauge of how the company is actually performing.
Good. Any summary comments on this?
I mean, for me personally, I think it's going to be good to in the long term, like, because now a lot of different companies were reporting their leases in different manners, like footnotes and other ways. So, like, if you were trying to compare companies, company to company, it would be difficult. So, 10 years, 20 years down the line, this is going to be really useful now that they're all being compared the same and they're all going to have to report their leases exactly the same. But I think for the next, like, 2 or 3 years, it'll definitely throw off some investors and accountants on how to actually properly report it until this is, like, finalized.
Mm-hmm.
Yeah, I
Good.
agree. I think it'll cause some confusion for investors, but in the end, overall, through time, people will adjust and be able to understand it more easily.
Okay. Good.